latest criteria. Make sure we show everything, net worth, all of those. Those are easily manageable things. But the main thing is to take a call on the fact that whether if you all
Good evening, friends. Friends. Good evening. So, friends, I am Ashish Agrawal. I am the Director of Resurgent India Limited. We are organizing the webinars on regular basis on the different topics. And so, first of all, I would like to welcome to all of you on this today's webinar, which is on very important topic where we are discussing the entry of NBFC in the credit card business and impact on banks in future. This is, I think, the need of ours. So that's why we thought let us discuss this topic. And we have very eminent panelists who are practitioners. They are involved in the regular basis, either in the NBFC space or banking space, or in the fintech area, or some of our panelists are basically those are into the facilitating the business also. So we have a very good panel today where we have Mr. Kunal Verma, who is the co-founder and CEO of Fero. I think FREO. So how do you spell Kunalji?
It's Frio.
Frio. Okay.
Yeah.
Good. So Kunalji, welcome to you in this today's webinar. Then we have Sachin Sachdevaji, who is Vice President of ICRA Limited. Sachinji, welcome to you in this webinar.
Sure, thank you.
Then we have Mr. PN Settiji, who is the CEO of Rupee Boss. Settiji, welcome to you in this today's webinar. And then we have Sunil Suriji, who is AGM of Union Bank of India. So we have a senior banker with us. So Sunilji, welcome to you this today's webinar. And then we have Dr. Ravi Modani, who is the founder and CEO of 121 Finance. So welcome to you, Raviji, in this today's program. So friends, as you know that this credit card, I think we all of are using the credit cards in the last many years. And we have seen this journey that I think it's an additional tool where we are not required to carry the currency and we can use the credit card and all. But this India, you know that one is India, one is Bharat. So so-called Bharat, actually, if you see, people are even are not having this kind of facility as of today, where the most of the cards which are issued by the banks, and the banks are basically having this lot of criteria, a lot of selection process and all, and most of the people who are filing the income tax returns, or those are having certain income level and all, they are getting the cards on regular basis. But the people who are in the small towns, those are having a small income, also informal sector and all, these people are still not using or not getting that kind of facility. So RBI has come out with the circular. I think they were having some guidelines earlier also, but practically these were not very clear, or they were not very, I think, detailed guidelines. So there were very few players from the NBFC space. Majorly the banks, NBFCs were there. Those were basically using the cards only. So now we see that after the new guidelines, there will be a lot of NBFC which will come out with these credit cards on this can be a game changer, where the people who are at the small town, small income and informal income people can get the advantage of it also. And there can be, they see that like the NBFC has done a wonderful job in the rural lending or the digital lending or MSME lending. In the card space also, they can do the same kind of, they can bring the same kind of change also. So, and if you see that recently the RBI also come out the guidelines for the co-lending and the coordination of loans. This is because of that the government has understood that NBFC has the better reach, I think better collection process or collection methodology. So somehow they have the government has trust on NBFC now that they should come into card business also. So this today discussion will be related to that only. We would like to make it more interactive, this program, so that the participation from the audience would be there. And I would like to thank you to the participants also who have joined us in this today's webinar from the different part of the country. And we have people who are banker, we have people who are from NBFC space, professionals, industry people. So all kind of people are here who want to listen us about this today's webinar, that how this impact this the new guidelines will impact the credit card penetration in the country. So friends, I have a small presentation which I would like to run through, where it can give you some kind of insight so that our discussion can be more fruitful. So next slide, Ron. So practically, as I already told that the role of NBFC and functions of NBFC, they are doing many things. Basically, they are developing their funding to the various sectors, infrastructure, education, MSME, and the other sectors. They have, I think, helped in the generation of employment also. I think lakhs of people are there who are working in the NBFCs to provide the financial assistance to the economically weaker section of the society. So to basically to unserved, basically serving the unserved. That is the motive of the NBFC. So they have reached to the every corner of the country also. And the economic development, definitely, when the small people at the small places are getting money, they are doing economic activity, and then this is helping in the entire GDP of the country. And so they are providing specialized credit. Now many NBFCs are there. Those are in healthcare, education, MSME, different areas of lending, and they are helping in the growth of the financial market. Next. So if you see this NBFC in the credit card space, as I told you that currently the penetration is very, very less. And practically, we talk about the financial inclusion, the credit card, I think penetration is very, very less on the financial inclusion point of view. And as of today, I think as per the RBI, two public sector NBFCs have the license for issuing the credit cards. So SBI cards and BOB cards, these are the two entities which are separately from the banks are issuing the cards. And we see the scenario. I think going further, there will be the NBFC like Bajaj Finance and other. They will look forward to come into this business. Next. Next slide, please. So if we see the NBFC and fintech, basically they are having the new age models also, like BNPL and prepaid cards and so I think this RBI is also trying to have this thing, the digital lending should be done at the faster this thing. So the objective is of for the inclusive growth, and these guidelines of RBI, which is for the credit cards, will be applicable from the 1st of July 2022. So I believe that this RBI circular, which was issued it will help to the entire sector also. Next slide. So just for information that the NBFC, those are having the net worth of 100 crore, more than 100 crore, they can issue the credit card. So for any NBFC to issue the card, they have to have minimum 100 crore of net worth, and they are having the NBFC license operating in India. They can issue the cards. Next. So I think this is covered. Next. So there are types of cards. I think there are different category of cards which can be issued. So credit card, co-branded cards, add-on cards. So RBI has come out the very clear-cut guidelines who can issue the credit card and how the co-branded cards can be issued. Also, we will discuss in detail. And the add-on cards also, because earlier the add-on cards were issued without any, I think, consent of the primary card holder and all. And I think these are misutilized also. So RBI has covered some guidelines on that also, where there should be some standard in the industry. Next. And so the NBFC, which are having 100 crore of net worth, they cannot start the issuing the card at their own. Basically, they have to take the approval again. So any NBFC looking to, I think, start the credit card issuance, they have to have the, so there should be board approved policy, should be have the all kind of mechanism, so that there should not be any challenge in the entire system. There are guidelines on the issuance of the card also, how the customer can be acquired, what can be the underwriting standard when you want to close the card. So earlier there were very many challenges. People have filed the complaint that they have requested for the closure of the card could not be closed. So I think the very recent circular they have covered, if after a certain time, after making the request within a certain period, if the bank or NBFC not closing the card, there will be a penalty which the NBFC or bank has to pay to the consumer. So I think this has happened first time that the institution will pay the penalty to the individual or the business house who has made the request for closure of card, and so because of certain things, this could not be closed, except there should not be any payment due. So there is a payment penalty of 500 rupees per day after a certain threshold limit of number of days. So these things are, I think, will bring some kind of, advantage to the consumer, to the card holders, and the institutions will also be very, very careful about these guidelines. And other than that, this interest also, they have come out with the guidelines. What can be the interest? How can be charged also? And other charges also, the guidelines are there. The recovery agents, appointment of recovery agents or direct selling agents and all, there's some kind of guidelines are also there. Billing, when the billing can be done, the unsolicited card like add-on cards and all. So there are guidelines on that also. Next. Then co-branding card, I think this concept is already there, where two organizations are joining two hands, and they are issuing co-branding card, mainly from some benefits which are passing on to the ultimate consumer. So there are some guidelines which have been issued for the co-branded cards also. Next. So again, in the co-branding side, just how the outsourcing can be done, what will be the responsibility of the co-branding partners. These things have been covered in the detailed circular, where RBI is trying to bring some kind of standard in all these things, so that there should not be anything hanky-panky in the system. Next. Next slide. So again, this co-branding, this is a summary of who will play what role actually. So there are approval, there are registrations, and the conditions also for the tie-up. Next. So these are the general guidelines, again, basically in terms of when the recovery agent can contact for the case of any delay in the card payments and all. The SMS can be sent on which number, what number, KYC, and so there are many operational guidelines are there, which I am not going in detail. Actually, we have a panel; they will be in a better position to guide us. Next, I think next. So practically, if you see in our country, there are many fintechs are there who are in this business. They are tied up with banks, and they are issuing the different kind of cards. So Slice is one of the big name in the market. So I think after these guidelines, they have to relook that how this business will be taken up further, whether they will go for their own cards in their own name, or they will be in the co-branding, or they so I think these are the players; those will take the I think lead because they are already into this business. So they'll find out the space for them, and they may be the first mover companies who can go for the license for the credit card. So this is related to that how many credit cards, how much credit cards are there? Basically, what is the number? So this is a old data. I think there are almost 62 million, so 6.2 crore cards are already issued in the country as of today. And out of that, I think 50% cards or 45% cards are inactive. So this is again a discussion point where the inactive cards are good, or the number can be reduced also. Next. So I think impact on banks and market. So we can clearly see that when the NBFC will come in the picture, they come in the business of credit card. I think it will take some time because it cannot done immediately. They have to apply, they have to get the license, or they have to get the approval from RBI. Then they have to set everything inside in the system, within the organization. So it may take 1.5 years to come out with that the cards actually. And but definitely it is clear that there will be I think impact on the banks in terms of I think they will create the different kind of market, and they'll reach to the small people, and they'll generate they'll I think develop the habits of using the card also. It can be online card or maybe the physical card also, but definitely from the overall understanding, there'll be more penetration. So 6 crore may become 16 crore. So 6 crore maybe this has been this number has come maybe within 20-25 years, but the 16 crore maybe there within maybe 3 to 5 years or 7 years. So this will be the major change. But by discussing with our bankers friend, I think this will be the good for the bank also, for NBFC also, because the market size will increase, the market will increase, then everybody will get the advantage of it also. Next. So friends, I think this is something which I would like to showcase so that we can warm up our discussion and can know that what are the guidelines of the government of India also from RBI. So now I would like to invite panel, the eminent panel for the discussion. So we have Kunal Vermaji, who is the co-founder of Hero. Trio, sorry, I'm sorry for that. So Kunalji, I think Kunalji is having very, very good experience of technology, and he has done 2-3 businesses in the past. Successfully, he run these businesses also. He has very, very good academic qualification also. So he's IT passed out from Roorkee and MBA also from ISB. And currently running this company where I think what you were talking, he was talking that he's already having co-branded card, and so he understands this space very well. And so first of all, Kunalji, I would like to thank you for joining with us. And we would like to understand from you, from your point of view, what will be the impact of this card, the card business from the RBI, from your point of view. And if you see that this credit cards are already seeing a tough competition from other players in the payment ecosystem, such as BNPL and the real-time payments. What can financial institutions do to compete and grow in this new environment? So again, card is the instrument which is prevalent in last many years, but this BNPL and real-time payment, many new things have already come in the system. So what do you think that how the card companies can compete with this new environment? And another question which we have in mind that this data sharing has been stopped. So I think this is a big thing which has come in the system. So what option do the non NBFC fintechs have for expanding their businesses? So these are the two things which you like to understand from you. And I would like that if you can brief about your organization, your journey in the card business, and then you can cover up these questions, that'd be great. So over to you, and thank you very much.
Sure. Thank you, Ashish ji. Good evening, fellow panelists. Really glad to be here. So just to address the questions that Ashish ji asked, first of all, Frio, as it stands, we are a consumer neobank, and we have three lines of businesses. We've been in the credit business. We have operated our credit business under the brand name of MoneyTap, which has been around for several years now. Credit lines, credit cards, co-branded credit cards, personal loans, all formats of digital credit products. We are one of India's largest credit line products, the first to launch it back in 2016. And since then, we've become the largest credit line provider in the country for consumers. We work in partnership with banks and NBFCs, and we have our own NBFC license as well. So we operate as a regulated entity. And in addition to cards and other credit products, we've also gone ahead and launched products in the pay later space, and very recently in some associated spaces also. The idea is to look at becoming a full-fledged digital bank of the future. But anyway, I think to address the question that you had at hand. So we've been operating in a co-branded credit card format for several years, right? And we know how the credit card business really works in and out. We've seen several cycles of markets ups and downs. Very interesting evolution that is happening right now. So if to your first question, Ashish ji, which is what is the impact that's going to happen on banks, and how do, from our perspective, what we think a lot of the banks may need to do to keep up with, let's say, pay later or real-time payment products. So if you see that credit cards traditionally have operated in higher income and lower risk segments, like you rightly summarized at the beginning, right? And the gross NPAs mostly have been in the 4 to 5% range, not more than that in a good year, right? Maybe in some cases better than that for some of the large institutions. But the fee-based annuity income model that the banks have been able to create, that has been a very attractive model, especially for banks that have scaled the credit card businesses to a very large volume, right? The top banks in the country. But off late, we can see that there have been newer companies coming in, like the BNPL sector and so on. And these companies have been focusing on segments that the banks traditionally were not catering to, which means newer to credit or higher credit risk or newer geographies, which resulted in sometimes thin margins, which also resulted in a challenge for these new age companies, wherein the standalone, it is very tough to build and sustain a business on, let's say, only BNPL in India. Right. But now what is happening is that on one end of the spectrum, these are traditional credit cards being facilitated by banks and large institutions. On the other end of the spectrum, you have real-time payments and BNPL products. Both of these products are eating into each other's segments now. Credit cards are trying to go to newer markets, and the newer products are trying to go after the traditional customers where the risk is lower and potential to make income is higher. Now, RBI's circular, my understanding is that it is extremely pro-consumer. The idea is to protect the consumer, to provide multiple options, and to also, I would say, propagate growth in the country. So what it means is that if you look at the circular, one is obviously that NBFCs who meet a certain criteria may be allowed to apply to the regulator for issuance of cards. It is not a given that every single NBFC who meets the criteria on paper will be allowed to issue cards. The regulator will check a whole lot of things: their vintage on running an asset business, their discipline, their regulatory compliance, their vintages. A lot of things will be checked, including promoter and company background. And only then will the decision come out in favor. So it is not a given that just because you have an NBFC license and you meet some net worth criteria, you will be getting the license. But what it will do for the industry, I think, is that the low engagement products will eventually die out, which means that if anybody was just issuing a card, like any bank was just issuing a credit card, if you see the circular, cards that are not active, cards that are not getting used for more than a year, cards where the customer does not want it, they have been unsolicited. All of these will have to be phased out, and the decision will be taken in favor of the customer, which means that not only is it going to be tough for some of the banks who are issuing cards but not seeing usage, it is also going to be tough for some of the new age companies which were acquiring new customers just by giving freebies. So you can acquire a new customer by saying, I'm giving you cash back, I'm giving you some gifts. So a customer will come to you, maybe use a card or a BNPL product. But according to the circular, if you are not seeing sustained activity, you will have to shut down the account, which means that now you need the customer to really use your product. So it's going to put pressure both on traditional banks as well as new age companies. It's not going to be just about issuance of cards. It is going to be about making sure that the cards remain active by explicit consent of the consumer. Now, what does it result into in terms of actual actions, right? How do, in my view, how would some of the traditional institutions, traditional banks keep up with the challenges that they're facing from new age companies? I think that some of the banks will have to explicitly focus on segment expansion, look at newer income segments, newer geographical regions, and a different profile of customers who can be eligible for cards. That is the only way they can start opening up a newer market for themselves. That's number one. Number two is that traditionally their reach has been limited because of the channels that they have used, which has been either a branch-led model or their native net banking application process, or a BC, that's a business correspondent model, right? These are the most popular models for banks to acquire customers. Now they will be forced to look at newer channels, which is particularly going digital. So either they have digital channels which compete with new age companies, or they have to partner with new age digital players. That is just how the wind is blowing, and there is no escaping that, right? So, I mean, if I have to put it in a different way, the civilization is moving, right? There used to be a stone age, now it is a phone age. So everything is on the phone. So there is no way that you as a traditional bank can escape. And when you come on the phone, you have to compete with the best app experiences, best product experiences. So if your experience does not measure up to the standards, you will lose business. So banks have to up their game on the digital front. The third thing is that the cost of transactions from traditional banks will have to come down. It will have to come down because only then will the business lines be more and more competitive, which means that a lot of these traditional banks might have to push for and accept newer ways of doing things like KYC, verification, even the merchant interchange norms that they have when they actually issue their cards. Even that might need to be relooked, because there's going to be immense pressure to keep the transaction costs down so that it is beneficial for merchants, it is beneficial for consumers. Just as an example, we are all seeing how UPI has changed our lives, right? Data which is a few months old in the country is that the value of total credit card transactions in the country was around 19 to 20 billion dollars in a month. I think it's a few months old data. So in 1 month, the total transaction value from all credit cards put together was around 19 to 20 billion dollars. In that same month, the transaction value of all transactions done through UPI was over 100 billion US dollars. UPI was launched less than 5 years ago. Cards have been around for more than 20 years. So this is a clear indication of the way in which the world is moving. So it is going to be more and more difficult for card-based products to keep up with phone-based products. So a lot of the new companies, some of them you mentioned about, Ashish ji, a lot of them are not really issuing cards right now. They're issuing prepaid cards. They're not issuing credit cards. They're issuing prepaid cards. They're riding on a PPI wallet on the back end, or or something like that. So actually, new age companies issuing credit cards is fewer in number. So the average Indian customer, still prefers low cost to high convenience if all else is equal. So it is very difficult to make a customer pay more. So I think costs will have to go down, and even new age companies which are not issuing credit cards, they're issuing prepaid cards, will have to relook at their business model, because the business model of credit cards is much more complex and cumbersome, because the entire underwriting and collection discipline is different over there. So if I would just summarize on the first question, which is for the banks, they will have to focus on segment expansion. Second, they will have to look at going into digital channels, either through partnership with digital players or themselves. And third, they will have to push their transaction costs down tremendously to be competitive with things like UPI and to be lucrative in the market. So these are three major things that the banks will have to look towards to be competitive in this market. On your second question, which is on the data sharing part, it's an interesting question, and sometimes it's very difficult to give an answer without pressing on the toes of certain parties in the ecosystem, right? If you say, well, if you look at the regulators mandate, and if you read it out and say that, look, there's a risk from new age companies, the new age companies might feel offended. At the same time, if you say, well, the traditional organizations have to step up their game on data privacy and protection, they might get offended. And if nothing else, the consumer says, well, what about me? You have to protect me. I don't care how you run it as an organization. So the consumer feels offended. So I think there is a no-win situation here as far as addressing data sharing is concerned without hurting somebody's feelings in the short term. But to address this objectively, there are a few things to keep in mind. One, what the regulator does not like, based on our understanding, our direct interactions with RBI, direct interactions with other parties in the ecosystem, is that institutional data, transactional data of customers and citizens of India going out of the regulated space, which means that data going into the hands of unregulated entities, foreign entities, or some of the big tech companies, everywhere where the regulator cannot go back and supervise and cannot regulate. Their customer protection is something the regulator cannot provide as an umbrella. And that is where data sharing has to be looked at very, very granularly, because RBI is very pro-consumer. So if you cannot protect the consumer's data rights and privacies because the data is being accessed by entities which do not come under your supervision, that is a huge issue. And that is the genesis of some of these concerns being put out there. So if you are an unregulated entity and if you have access to transaction data, there is no way of anybody to know what you're doing with that data. Is it parked in a server inside India, outside India, where? Right? As we have seen through the years, lots of steps have been taken. There was a step taken by the regulator and the government saying that the data should sit on servers sitting geographically inside the country, whether you are using a cloud-based server or whatever. Then there were steps taken to curtail the access to Credit Information Bureau data some time back, again to make sure that the sensitive credit information is only accessible to regulated entities and related parties which can be regulated. So if you are unregulated, it is going to be tough for you as an entity, no questions asked. You will have to get into a legitimate outsourced contract with a regulated entity and play by the book on the IT and data norms. And you might still not have access to transactional data, but you might have to rely on certain analytical insights, certain trends and patterns of data which the regulated entity might share with you. And then you use that information to provide better customer service and add value as a player. So for regulated entities, data access as such is not going to be an issue. So if you are an NBFC or you're a bank and so on, but the most important concern is going to be the transaction data getting misused, even if you are a regulated entity. So who do you pass this data on to? Right? If I order a product online, if I order, let's say, a vegetable biryani on one food ordering app and my credit card is used for that, and tomorrow other companies are trying to use that transaction data and trying to sell me other things, that's a huge problem. So my data is being peddled around, which is frustrating and dangerous both. So this data has to be protected behind secured walls, and that can only happen as long as the regulator has a control over the entity. So to keep this under control, the fact that it does not go beyond access, similar action will be taken, I think, in the future also, where there will be regular audits and so on. To regulate unregulated entities, what one might need to do is, one, you need to get into very airtight contracts as either service providers or BCs or marketplace models with other regulated entities. But you have to come up with your own very clear value addition, because if raw transaction data is not going to be available and you cannot add any other value of your own, then your significance is going to go down, because over a period of time, the regulated entity will develop that service in-house. And because you don't add any value and you don't get transaction data, regulated entities will not be willing to pay. So, which means your business model will come under serious amount of threat. So today, if you are just a pure fintech player, so to speak, if you're issuing any product without thinking about all of these things, then you will have to rethink the whole paradigm to make sure that your business model is not just dependent on using transaction data and monetizing that data, but to clearly create independent value and collaborate with regulated entities to just use analytical insights from transaction data, but do not expect to have access to the data. I think with that, I'll pause. Ashish ji, I think I've tried to address the questions.
Great insights. I think lot of things we have covered in that discussion. So that's great. I think for the audience, we have this thing, one question. Who is the market leader in the credit card in India? So there are options, 3-4 options are there. I'll request to the all the people who are attending this webinar, please, I think vote for that. What are the your options? Then we will publish the result also after this submission by you. So just for I think for your answer, we are showcasing it here. So please mark your answer in this sheet, and we'll publish the result also after some time. Okay. So now we have friends. Now we have Sachin Sachdeva ji, who is the vice president of the leading rating agency called ICRA Limited. And Sachin ji heading that this thing, financial sector ratings. So he has more than 14 years of experience also. So nobody can be better than him, because rating agencies are having the all I think information about the banks and NBFCs and the company which are issuing the credit cards, and you have already done the ratings for many organizations. So Sachin ji, first of all, thank you very much. I think you have a great experience in the financial sector. So I think I think everybody looking towards rating agency, what is your take on such kind of guidelines? So Sachin ji, we would like to understand from you the size of credit market. This credit card market is likely to grow from here. I think that is very clear. And also RBI has tightened the NPA classification norms for NBFCs. Given the unsecured nature of the business, because credit card is unsecured kind of business, a new to credit customers and new business models emerge. What steps should financial institutions to take to keep NPA in check? So basic question is related to the new entity which will come in the credit card business, how they can keep the check on NPAs. Oh, great. So these are the results which have been published. So most of the participants have given the I think this HDFC. I think they marked this HDFC. Great. Thank you very much. Thank you, audience, for your answer. So, and the another question is, the small number of credit bureaus in India has affected the ability of credit card companies to undertake a risk. Following the revised guidelines, the number of card issuers is expected to rise further. Your views on that? So these two things are there. One is the NPH, how to control the NPH in case of unsecured business with credit card, and the credit card bureaus take on that actually. So over to you, and thank you very much.
Sure. Thanks a lot, Ashish ji, and warm good evening to all my panelists and attendees. Thanks a lot for inviting me to this webinar with a so good panel to hear different views here. Now, I am a part of Rating Universe. I have been associated with ICRA for last 14 years, as Ashish ji already mentioned that. Over the years, we have rated various NBFCs across the spectrum, most of the banks, NBFCs, and even fintech players who are present into the new age lending, if we were to use the word, basis about the data analytics and all that. So we have been rating them, we have been seeing their business model, and we are seeing how the businesses are doing and what are the kind of challenges they are facing. Now, specifically when we talk about credit card or say NBFCs present into the credit card business. So one aspect which one would need to highlight here is two NBFCs were already present into the business, into the credit card business, SBI cards and BOB, definitely because of the association with the bank. So stating that it is an entry of NBFC, I think we should avoid calling that as an entry. One can say it is an enlargement of the scope, that now explicitly RBI is inviting more NBFCs to come on board and enter into this space. Now, what is the objective here? The objective here is the credit card is already going into the country. For example, recently we have around 7.5 crore kind of credit cards issued in the country. Some might be out of that would be inactive, but still it's a good number. But when you compare it with the whole population, even to the whole working population, the adult population, not just even counting for the say non-working part, there is still a huge scope to grow. And Kunalji also mentioned about the comparison with say UPI, the kind of volumes which we are generating, the credit cards. So there is definitely a significant scope there, and none other than better than NBFCs would stand here in a position to tap that market. Reason being, so far, given the high cost structure, the prime segment, may say the salaried segment or the business class, where you have a good credit information data available, you have the banking behavior available. There, the cards have been issued, a significant penetration is still there. But how to reach the masses where you don't have that level of credit history available online, or irregular repayment behavior, undocumented income levels, which NBFCs have been doing for so many years. NBFCs have been reaching to customers because of their reach, because of their cash flow assessment models, if they are following income assessment models, they have been underwriting those customers. Definitely, they were not allowed to give this kind of unsecured product, which is a revolving line, which is a free limit given to a customer. That was still not there. But in terms of their underwriting, their understanding of those kind of customers, it was still there. So what these regulations have bring in forth is that now it is a product which NBFCs can now offer on their own, in which they were earlier doing in the form of co-branding with the partner bank at the back end. Now, there are several questions which need to be answered here for the NBFCs to grow their business model. Definitely, it's a positive. Whichever entity gets that license, they will have to showcase their wherewithal to reach the masses, because unless you generate a good level of volume, in order to reach the masses, the cost will remain high. It will not be a profitable venture. The kind of mix you are going to generate. That's why the circular also talk about the underwriting standards, underwriting practices, because you need to obtain a certain mix in terms of what are the kind of transactors into your credit card portfolio or revolvers, because high revolver would mean higher risk, although high income, but high transactors only would mean you're not generating enough income. You are only relying on the fee income, the non-interest income. So how you balance all those out? In the past, in the existing NBFCs or even the banks holding the credit card portfolio, although there is no separate P&L available for those banking sectors, but if we look at the NBFCs, the credit cost before the COVID time were even in the range of 4%, 5%, or even reaching up to 6% level. During COVID time, definitely the credit cost increased significantly, because these were the times when all the customers were affected, entire economy, entire borrower class cash flows are affected. So because of obvious reason, the cash flows of credit card customers are affected, and the delinquencies increased, credit costs increased significantly. Now, how do you control all these things? So you have two aspects to control. One, as I mentioned, about how you model your business structure, how you control your operating cost to reach the masses, and second, how you control the credit cost. Your question also talks about the controlling NPAs. That's what we are going to talk about now. Now, as I mentioned, from an underwriting perspective, NBFCs have already been doing that. There is no doubt. Only thing is, with this new product coming in with different features, the segment would change in a way. The behavior of a customer using a credit card, or behavior of a customer using a personal loan, or third category, a behavior of a person taking loan for running the SME, running the business, running the shop, running the warehouse. Now, there you have a defined structure, defined repayment pattern. Even in a personal loan, you have a defined repayment pattern in terms of you have taken a loan for 2 years, 3 years, 5 years, you have a defined schedule, you make payment, you assess the cash flows accordingly, price in the risk, and after that you give the loan. To some extent, you do that. But in a revolving facility, for example, a working capital loan, but there you have a backing of receivables or backing of inventory, which is not a case in a pure play overdraft kind of a line available to customer to use at will. You define a limit, they use it, they borrow it, they repay it, they borrow it, they repay it. Now, understanding that customer behavior, understanding those data patterns, how customers are using, where they are using those transactions for doing the transactions, and when will they make the repayment. Will the NBFCs be going ahead and doing, say, credit bureau check only once at the time of issuing a card, assuming that the entities which they are getting the license? One option is only to do bureau checks and all that at the time of issuance. But since it's a revolving line, would they require to do it, say, maybe on a monthly basis or quarterly or half yearly basis to understand the pattern? Because these are unsecured revolving lines. What you have borrowed today, you might pay back after 6 months, you are again borrowing that. In order to keep that line live, you will have to build in incremental steps in terms of doing maybe bureau check and keeping a tap on their transactions, because you will have only access to, assuming that you get a license, the transaction data is also available to you, but that will be limited to only that credit card which you have issued. But all other transactions which they are doing, all the financial transactions which they are doing, which may be much higher in terms of the transactions with the bank as compared to NBFC, and NBFC will not have access to that data. So how do you obtain that access? How do you keep on assessing them regularly without increasing your cost? Because if it increases your cost, your profitability will take a hit because it takes time to build a wall. So all those questions need to be answered, but I would call them as an operational challenges. I won't call them as any threatening thing that which an NBFC cannot crack the code. It might take maybe 6 months, maybe 1 year, maybe 2 years timeline to streamline all those things. Over last few years, we have seen how credit information companies, the credit bureaus have evolved. You mentioned that it has been a small number, but if you look at last 4 or 5 years or even 6 years, even for MFIs, you have now credit bureaus where they're taking their credit history and distributing. Even from an asset class perspective, at the lowest rung level, the customers, the borrowers have understood the importance of credit information companies. That if you default at one entity, the credit records gets out of order, you will not be able to borrow more. So that has played a very important role. So whosoever is now transacting online, entities are deploying data analytics, artificial intelligence to understand their behavior. Even talking about Facebook posts or Twitter trends or their online photos, they are trying to understand what are their income levels, what are their spending patterns, whether that person, that customer is likely to default or not. So all those kind of things entities are doing, no doubt on that. But when you go to tier 2, tier 3, or even lower now, their consumption pattern or their expenditure pattern would be totally different from a person which we are currently talking about using a credit card. Even a mindset for the people in tier 2 or tier 3 city to use credit for consumption, they don't take that very positive. Can you reach them? If you not, the prime segment has already been catered to by the banks. They have already taken a very significant share there. How will you differentiate a product? End of the day, it is a credit product. You can add on feature, you can build things, but most of the entities, most of the banks are already adding a lots of features. How do you differentiate that product to achieve that growth? So balancing between achieving growth and controlling NPAs, that would be related to your data access. If you get the data access, you run your underwriting model, you keep on doing that assessment again and again. You cannot rely on one moment that today I have issued a card, I have done assessment, it is fine. No, you have to continuously monitor the pattern. You have to continuously keep on doing the assessment. Only then you will be able to keep your credit cost under control. Because if that goes out of hand, then definitely it will be a loss-making proposition.
Great, sir.
And
Great, Sachinji.
yeah,
I think you've very well covered, and I think from the rating agency, what we can expect, you've rightly given that perspective that we need to be very, very vigilant whenever we are doing credit card business. So great, sir. A lot of insights are there. Friends, now we have PN Sethi, who is the CEO of Rupee Boss. So Rupee Boss is basically say very good platform, or I will say a company which is into the different kind of financial products which you are, I think, facilitating to the different kind of consumers. And Mr. Sethi is having very, very good experience of more than 25 in the financial sector. And he started his career from the direct sales representative. and he had reached to a very, I think, senior level in the company called Andromeda, which is the largest, I think, facilitating agency. So, and he's running now his own organization, right, Boss Financial Services. So, first of all, welcome to you, Shetty. Shetty, I think you have seen many many banks, many NBFC where you have already retired. So, from your point of view, we would like to understand basically in terms of the cards which are basically co-branded card. Which you see that this is another big market. So there, the share of revenue for the co-branding partner in India has been low, unlike developed market where spends are high. What does the future have in store for credit card co-branding area basically? So what do you see from your point of view in the co-branding side in terms of the profitability or the revenue, increasing of revenue also? And the second question which we have for you is, it is credit card have lost ground to aggressive fintechs like Slice, which offers a 90-day interest-free period and up to 2% rewards. And so if you see that 90 days interest-free and 2% service reward also, and so this new basically thing will lead to more disruption in the credit card landscape. So your thoughts on that? So two things. One is this thing, the co-branding partnerships or co-branding, impact of co-branding in the future on the revenue of the credit card companies, and the company like Slice, which are doing a disruption in the market. What will be the new change or new thing after the lot of other companies will come? So over to you, sir. Sir, you are on mute.
Yeah, thank you, Ashish ji, and welcome to all the fellow panelists and attendees. Yes, I run a company called Rupee Boss. We are a pan-India distributor for financial products, your home loan, mortgage loan, unsecured business loans. And why I agreed today for this webinar is that I started my journey through selling Citibank credit cards, right? I've seen days where credit cards were given only based on visiting card or a boarding pass, or if you being a member of a club or any other premium outlets, right? So today we have already done about 5,000 crore SME loan disbursements, and we would like to get into credit cards in SME space and the employees of SMEs. And Ashiji, coming back to your first question, that is, what does the future have in store for credit card for co-branding scene? So if you look at that, which are the three premium sectors which are doing well in co-branding? One is e-commerce. Your Amazon, Flipkart, co-branded with the banks now, or they have coming up with their own credit cards. Then fuel, IOCL, HPCL, BPCL. Then your travel, IRCTC, Make My Trip, all that, right? I think as we move along, this revenue things, I think between banks, fintech, NBFC will figure it out. Okay. The important thing is value, right? As Kunalji mentioned, the RBI want the cards to be used. Now, if everybody need to work on coming up with the co-branding card, which can add value where it can increase the usage percentage month on month. I think that is going to be the key thing when it comes to co-branding card. I think branding, revenue, what happened to insurance sector, they have managed it so well. So I think even this, the players will manage that part of it. I think the important thing is to come up with a real good product in the marketplace of co-branding where consumers can use it on a maybe day-to-day or a monthly basis. Coming back to your second question, whether in terms of new age companies entering into space with 90 days free credit, all that, I think in the near future, I think the game today is going to be the collaboration between banks, NBFCs, fintechs, and distributors like us, right? So there is space for everybody. And in today's market, banks have real good database and they have an upper hand today. Yes, change is the only constant thing in the world. One has to innovate in their products. I saw the Slice usage. I think it's user interface, the way customers are going to, if it is going to be user friendly, customer will pick it up, and obviously that will become a super success in the marketplace, and that's the way forward. So that's what I believe. I think collaboration between banks, NBFCs, fintech, and distributors. I think that is going to that, and in a way, whatever is happening is both credit card market industry is expanding, and that will bring stability, and it's good for the consumers as we move along.
Right, sir. Thank you very much. Thanks for your very good insights about both the areas which we were trying to understand. So, friends, now we have senior bankers with us. So we have Sunil Suriji, who is the AGM of Union Bank of India. He has spent almost 34 years in the banking. So, sir, I think you are the right person to deliberate on this panel, where along with the other panelists, where when we are listening the views of fintech and NBFC, we need to listen the views from the banking point of view also. So, sir, we would first of all thank you very much for joining with us. And we would like to understand from you two things. One is the payment ecosystem in the country. The RBI has come out with some guidelines also. So, how do you see this payment ecosystem in the country in the near future? And will the entry of NBFCs, particularly the large ones like Bajaj and all, the credit card business, if suppose they come into the credit card business, what will the impact on the banks? I think because currently practically we see the banks are having monopoly in the credit card business. So over to you, and thank you very much, sir. Sir, you are on mute, sir.
Hello.
Yes, sir.
Thank you, Ashish. The one part of that was RBI circular permitting more number of players in this market, RRB, cooperatives, banks, NBFCs, has been very well deliberated upon. And as a banker, one thing that Mr. Shetty was telling, that the banks are sitting on a very big database which has not been capitalized, which has not been utilized, which has not been leveraged. So that is the one area which the banks have as of now. And the other thing that comes to my mind is that there are more number of players in the market size increases. And that is going to be the helpful for the banks as well. And as you said, the question you framed, it's a near monopoly, it's a oligopoly, monopoly, whatever the terminology that you want to use. But the overall beneficiary would be the customer, because the customer will be having more number of options to choose from, number one. Number two is that once the market size will increase, the banks and the NBFC, they always settle down to search their niche market. The segmentation will take place, the product differentiation will create a segmentation. And that segmentation will create a niche markets. Some players will continue to operate on all the sectors. Some will go to the Tier 1, Tier 2 cities, and some may go only for the service classes. Some may go for the traders. But the bigger challenge, as one of our panelists has discussed, that credit card is into the scene for more than 25 years. And UPI came into the scene just 2 years back. And the UPI has got 4 times transactions than the credit card. The reason, if you go for that, if you try to analyze the reason why it is happening so, is the merchant acquisition cost. The merchant is more comfortable in getting the payment through the UPI than getting it through the credit card. So that is an area where we need to work out, and the merchant acquisition cost has to be drastically brought down if we have to broaden the credit card. One thing. One more thing, one of the panelists was discussing about the bank's futures, all that. Everybody knows that what is happening with digitalization, the kind of pace that our country is maintaining. So if we continue with that kind of pace, I joined the bank some 34 years ago, when there used to be a lot of ledgers and lot many staff were working there. Right now we are having more than 10 times the business, and the staff strength has gone down by 10 times. The 10 times business is being controlled by the 1/10 of the staff. So that is the strength of the technology, and that strength will take it further to phase where we would be making lesser and lesser brick and mortar banks, more the digital banks. And you may find many of the banks in the near future will come into the scene with the advent of these fintech companies, where we may not be having these banks, physical banks, but those fintech companies would be entering the business in such a big way that they will be impacting the whole market, the whole paradigm of the market. The costing structure will come down, and that will really bring a big day for the customers. And with that, I want to conclude that more the players, bigger the market, and the customer is the ultimate beneficiary. That's the only thing that I have to say. Thanks a
Great,
lot
sir.
for giving me.
Great, sir. Thank you very much for, I think, crisp answer what you have given. As a banker, I think you are very, very positive where you are seeing the opportunity rather than the market will become big. Then definitely this will be the advantage for both the NBFC and banks. So I think future is bright from that point of view. And I think whatever you said, it is true that everybody will get the advantage of it. Thank you, sir. Friends, now we have Dr. Ravi Modani ji, who is the founder and CEO of 121. Actually, there is a company called I2I. So I am always linking with that. Sorry. So 121 Finance. And Ravi ji is having very good experience the technology side, NBFC. So he has this company which is into factoring business, factoring NBFC. And he has PhD in, I think, this doctorate in this working capital management, which is something very unique. Actually, I have not seen this kind of degree. Definitely must have done from outside India. I think India, I have not seen this kind of options. And he is currently the president of TAI Rajasthan also. So you are involved in many things, VG, and you are running this NBFC where you are doing factoring business. So from this credit card point of view, we would like to ask some questions from you. There are two questions which are there for you, basically. First of all, I think thank you and thank you for joining with us. So this you see that in the past, this HDFC Bank and the having restrained from issuing new credit card, MasterCard was bought indefinitely from onboarding of new users. SBI and even SBI, experience system outages. For the new entrant, what would be your advice, basically? What steps they should take so that these kind of pitfalls should not happen in their system, or they should not face this kind of challenges? And one more thing, the business card. Actually, we are talking the card. I think major of the cards are individual cards, where I think we are using for personal use at all. But business card is also a big market, actually, business credit cards. So if you can highlight on that also, where the MSME and the other organization, what will be the benefits of these organization when the NBFC are coming into the credit card business. And one more question which we have this basically, this is related to attract and retain clients. Several credit card companies have relied extensively on the rewards to customer. Is this a model that can be used in the future, or will NBFC be compelled to join the party? So over to you, and thank you very much, sir.
Thank you, Ashish, for having me here. Good
Thank
evening,
you.
everyone. It's a real honor and privilege, and speaking at the end, listening a diverse panelists from rating agencies to banks. It's a great insight. So let me introduce. I am Dr. Ravi Modani, founder CEO of 121 Finance. We are a NBFC focused into B2B working capital space. So we are the first NBFC to be categorized as NBFC factor by RBI this year after the new guidelines of 2022. And we are a digital factoring finance NBFC for the MSMEs. So we are totally NBFC into working capital, where we do digital transaction, very small transaction as well. And that's totally focused into B2B. So we may have transactions which are equivalent to the B2C size, but the focus is in terms of factoring. And so we do all of, invoice discounting and factoring and supply chain finance for these smaller ticket sizes, right? So that's about 121. Coming and answering your question about the first part about the HDFC and YOLO and the MasterCard, I think I'll agree to what Kunal said earlier as well. We have a saying called love your neighbor, right? So I would say love your regulator. So the Indian regulator, RBI, has been a very proactive regulator. We have seen, we have been able to sustain all the crises of the world, whether it's 2008 and today, whatever it is, right? So I think even if you see the increase in the rate which RBI did a few days ago, they have been always proactive. So I think what are taking between HDFC and Mastercard, they and SBI as well, all of them were restrained for various different reasons, not for the same reason, right? So if Mastercard was about data storage, HDFC was about the technical glitches on their side, and YOLO was about technical glitches from the customer end side, right? So all of them are different perspective. And I think, going forward, the NBFC, what they bring to the table is the technology. So adding one more thing, when people were saying about BNPL, which is buy now pay later, fundamentally BNPL is like a credit card, because you are buying something and paying later. Now, if the fintech companies can today deliver a product called BNPL totally by technology, why would you need a physical credit card? I mean, we have seen virtual cards coming up together, right? So it at all in the future, whether it's an NBFC or a bank, they want to issue a credit card. So credit card may be a concept, maybe a virtual credit card. We may not require physical credit card, right? But fundamentally, it's a buy now pay later. So I think any NBFC venturing into this should be on the right side for technology, because technology is the future. And also, I would like to add, which is the biggest fintech? I mean, fundamentally, any bank is a fintech. If you remember, if you see, the banks are operating their core CBS and the core systems. So as I'm as a user can go to the bank, do my banking transactions. So they are the biggest users of technology, right? So if the NBFCs want to disrupt or enter the credit card market and be a challenger to the incumbents, they have to be disruptive into technology. I think that is one thing which that will be the core to beat the, or rather give a good fight to the banks for the credit card. Coming to your second point, which you mentioned about the business credit card, this is just an extension to the BNPL, as I mentioned to you, because when we also do business limits to the MSMEs, fundamentally we are giving them a BNPL product. Apart from when we're doing a reverse factoring, it's fundamentally a BNPL, whether it's a MSME or a large corporate or anyone for that matter, right? Now, to make the things easier with all the UPIs and technology in place, and now the PA and payment aggregator and payment gateway license also being awarded by the RBI, I think this is just the right time for people to enter a business credit card space. And let us be very clear, we are not mixing the corporate credit card and the business credit card. And primarily the need of a business credit card would be for the MSMEs or the SMEs, right? Because they are the people who, and maybe, if I think in a manner, this business credit cards, unlike a normal credit card, where I can go to any merchant where there's a Visa, RuPay, whatever it is, and a swipe a card, maybe the business credit card could be restricted for some payments, let's say for the taxation payments, the indirect taxes, direct taxes, or maybe pre-approved vendor as well. I mean, so there's an end way of controlling how the money flows to the from the business to the end user, right? So it's a very strong use case, and with the technology in place, this BNPL can be called a business credit card for the MSMEs. Another point you mentioned about the giving the discounts and giving the cashbacks to the customer retention. See, one thing very important is, what are NBFCs? NBFCs have got their domain knowledge. They have something called a distribution reach. They have got something like a technology. They have they know the pulse of the market. So fundamentally, if I go back, and there was a very old saying by Bill Gates in 1994, he said, "Banking is required, banks are not." And I think we are all moving towards that where the entire asset side of the banks are being dismantled. Somebody's picking up credit cards, somebody's picking up loans, somebody's picking up neobanks are there, which are picking up all the customer side. So maybe the banks would be left to handle cash, maybe left to take deposits, right? So when we are carving out that particular side of the banking, we should also understand what are we delivering, right? So I think one of the biggest reasons the NBFC can really disrupt the credit card space is technology, their reach, their domain knowledge. So also, if we have seen in the past as well, I think credit card maybe for the last 20 years, I would say, have been based because of the data and technology. Because if the technology was not there, the mass reach and the numbers of credit card could not have been handled. Now, when there's underlying data, phenomenal data over there, right? So then it becomes imperative for all the NBFCs to, you have a different use case, underwriting tools for that. And as far as the discounts and cashbacks are concerned, I think as long as somebody pays it on time, there is no harm in passing on the benefit to the person. Nobody gives a cashback or a discount to who person who's a defaulter. It may be just a part of the CAC to get the customer on the first time, but once he defaults, nobody gives him a cashback to retain that customer, right? And everybody would like to retain a good borrower a number of times. Maybe the marginal cost of lending also goes down. So, it's basically rewarding a relationship between the credit card company and the consumer. Another thing I would just like to add over here, the convergence which is happening in the industry. If we put up broadly the BFSI industry, there's a lot of things in terms of convergence is happening. So people are doing credit card, people are doing banking as well. And one important point that we've missed out in the part was account aggregator. So at 121, we have been the pioneer to onboard OCAN, which is Open Credit Entitlement Network. So what's happening, what UPI was to payment, OCAN is to credit, right? So we have been doing lending on OCAN since last year on the GEM side. And this is totally disrupting with a 2-minute end-to-end digital loan for a MSME supplying to the government. And when the government is making a payment to the NBFCs, this is never heard of in the country like India and maybe nowhere in the world. So the same way, the account aggregator, this is the most disruptive thing which will happen now. When we are talking about data sharing or data intelligence, I think now with the consent-driven architecture of Sahmati, account aggregator will make the life so disruptive for the credit card industry. So whosoever adopts account aggregator fast, and the NBFCs being more agile to do it, they will be able to carve out the lot of consumers away from the bank. And people like Bajaj Finserv may be having the largest database for the consumers in their consumer side as well. So I think it's a good time for the NBFC that they can leverage their distribution, domain knowledge and technology. They can do a disruption into this industry. Thank you so much for hearing me out.
Great, Dr. Ravi. I think you have given very, very good insights from your point of view, and definitely you have given the lesson that also that whenever the NBFC are planning to come out with credit card, they should see the many factors like data, technology, and other things. So, friends, I think we have a good discussion. We had, I think, a lot of insights, a lot of I think area we have covered in this today's discussion from the future point of view. And everybody you have participated in I think very well defined manner where I think you have covered all the questions very well also. So we have some questions from the audience also. So majorly the questions are I was just getting this question. So majorly the questions are from the consumer point of view. The people would like to understand that they whatever the interest they are paying as of today on the cards, it is on very high side actually what they are thinking. So if you see that when the NBFCs are there in the business, again the definitely the rate of interest are on higher side actually. So people are asking that whether the rate of interest will increase or will go down for them if they are going to buy the cards from the NBFC. Although it's a very premature, but if anybody of you can give some thought on that or any idea on that from your point of view.
I think the rate of interest on the credit card is not a rate of interest; it's a penalty basically. If somebody understand on a dynamic level, right? Basically, it's not a loan which people are taking in terms of delay. And in terms of getting an EMI and buying something on the credit card, there are a number of options available without even a credit card. Because remember, in the credit card, there's a merchant discount rate also involved, right? So it's not only the card issuing company or the bank which is involved. There are settlers, there are inter-exchange, acquirers. So many people are involved. So I would believe that more than the rate of interest, we should consider this to be a penalty for not being disciplined rather than a rate of interest.
Okay. So what are your take basically, whether this will be on the higher side when the NBFC will come in the picture, or they'll be
I don't think so. This will go down. This should be, I don't think so, because the cost of funds of NBFC is in any case much higher than the banks.
correct?
So because the NBFCs are basically the resellers for the bank, right? So they won't have, that's what my take is. Maybe Kunal and PN can answer it more better, but my sense of understanding is it will not go down.
I think even today, credit card interest rate is very high, even in banks, even today. So there will not be any much difference in bank or NBFC when it comes to credit card rate of interest. As Ravi said, one should use this free credit period of 30 days. And if you want credit, you take personal loan. I think that's my take.
See, I think the two things, the credit card business makes money through either transactors or revolvers. The world of transactors, which are people who pay back in 30 days, I'm assuming like a lot of us over here. There, the main revenue model for banks is fee-based income. And if you look at any bank which has a large card portfolio, out of the entire fee structure, around anywhere between 15 to 20% of the revenue in a large bank is coming from fee-based income. And credit card fee, the asset side, is a major part, which a contributor over there. So getting more and more good customers, higher quality customers, which does not put pressure on your NPAs, means the contribution of fee-based income is going to go up. Now, the interest part comes in two sections. One, when you're a revolver, which is that you don't pay the dues in your 30-day period, you revolve the credit over, which means you pay the minimum amount due. So if you have a 100 rupee credit card statement, minimum amount due is 5%. So you pay 5 rupees. Baki 95 rupees has to roll over next month. There, the average APRs on credit card goes from 36 to 43% per annum in India. So if you are, that's like almost 3 to 3.25% per month. That's the standard in credit cards today in India. A lot of people don't know this. Plus, if you want to take cash out from a credit card in an ATM, you insert your credit card in an ATM to take cash out, there is like a flat fee. Sometimes it is 300, 400 rupees, and then there's interest on that. If you swipe your credit card and let's say at a merchant, you buy something, let's say at a Chroma or a Reliance or even pay for coffee. There, if you want to convert a transaction into an EMI, there are different EMI plans, and those interest rates could also be maybe 18%, 20%, 22% per annum. So in all scenarios, because the inherent cost of a card acquisition and card processing is slightly higher, on the interest side, the margins that a bank makes net of losses will only come if your interest rates are higher. And if you see, the trend here is that globally, credit cards are used like credit instruments, like borrowing instruments. In the US and all, you can borrow on a credit card. You'll have like 1%, 2% interest rate. In India, credit cards are not positioned as borrowing instruments. In India, credit card is positioned as a payment instrument, wherein you pay, and in 30 days, you pay the dues. So in primary use case of credit card has been payment instrument, not as a credit instrument. Like Shetty ji just mentioned, that if you need to borrow, you need to look at other formats of borrowing if you're doing, because this is very expensive. If you're borrowing traditionally from a credit card with these rates. Now, to Ravi's point, like the cost of capital for NBFCs is high. Absolutely spot on. I'm an NBFC. I know in that sense. So I don't see that unless you can magically kill your transaction costs and you can have collection efficiency, which is better than banks. I don't see how you will generate higher spread as an NBFC. In which case, the only way you can reduce pricing is if somebody else is paying for it. So if you are a consumer company where you have a foreign equity player, and we have seen this movie play out multiple times in our country in the past 2 decades, where a foreign private equity investor will come and fund our biryani orders and cab rides and a lot of things. Unless something like that happens, the pricing cannot go down while maintaining strong unit economics. So it can happen. The pricing might go down as an acquisition strategy, but ultimately the music will stop in these musical chairs. One fine day, somebody will be asked to show the unit economics and the private equity money will run out. So you will have to come back to have fundamentally strong unit economics, in which case you need to beat the banks on their cost structures. Like Sunil ji had earlier said, their strength is the cost in a big way. So short-term pricing might go down as an acquisition tactic, but sustainable basis pricing going down on credit cards and NBFC, too many levers need to turn, and some of the best institutions might be able to do it, but I don't think it will happen as a blanket rule.
Okay, great.
I have another take on this
Yeah,
costing.
please.
See, the interest cost will come down drastically. There are two, three. One is the acquisition cost, one that we discussed. One is that servicing cost and all those things. The other is that the failure, the NPAs those are created by the system. But in the kind of the rating agencies that are working, the rating of the customer, with the rating of customer, the selection of the customer, the process that goes through, delinquency is coming down drastically. It is coming down because people are concerned about the rating and all those things. Once this delinquency will come down, then the interest cost has to come down. That is my take.
Great, sir. Great. I think very good information which you have given. I think Kunalji, you have given information where I think you have given the guidance also that how to manage your business when you are into card business, credit card business. So friends, I think we have already crossed our time limit. So I think I would like to summarize and close the session here. So first of all, I think we had a good discussion where we could cover up the many aspects of the credit card to be issued by the NBFC from the regulatory point of view, from the practitioners point of view, bankers, credit rating agency, the fintech companies, and the company which are already in the card business. So I think the ultimate crux is that from the bankers' point of view, they are very positive. They are seeing a lot of opportunities when the new companies will come, the new people will come in the system, and the habits will also change. So the pie will increase and everybody will get the advantage of it. So this is a very, very positive statement which has been given by Sunilji. And I think as a banker, as a seasoned banker, his views are very, very, very important for us. Then the rating agency point of view, as Sachinji has given the lot of insight that how the rating agencies are seeing. So he looks also positive that there will be some, I think, fair competition also in the market. So that is good. And the other dignitaries have also highlighted on the various issues, technology, the international aspects of the credit cards. And you see that how the market will evolve and the co-branded credit cards. So all these things we have discussed today, and in the nutshell, I will see. I think everybody is very positive that this new guidelines will help to grow the market. The new companies will also come in the market, and I think this will be overall positive to everybody. So thank you very much to all the dignitaries, all the panelists for your deliberation, your time, and your valuable suggestions also. And we are really delighted to have you in this today's webinar. And then I would like to thank you to all the participants also who have joined in this today's webinar from the different places, and they have made it more interactive also. And I would like to thank you to all the Resurgent India team members who have contributed to organize this webinar, where the digital team and the conference organizing team and the people who have worked on the presentation also. So I would like to especially thank Grishma Doshi for making the presentation. She did very hard work to summarize all the inter-circular in one presentation. And the Rohan and the Devesh and Joginder, the other people in the team. So thank you very much. I think let us see. The time is not, I think, very much ahead. I think July, this will be from July onward, it will be applicable. So we'll see that how many companies are coming into this business and how they are shaping up the business also. And the ultimate goal is that everybody should get the benefit of it. So thank you very much. Thank you all, and wish you all very happy and healthy. Thank you once again. Thank you.
Thanks.
Thank you.
Bye.
Thank
Thanks a
you.
lot.
Thank you,
Thank you.
everybody.
Bye, everyone. Take care.
Thank you.
Sachin ji, yeah.